So what is growth investing and how is it different from a very popular style of investing, which is deep value investing? Well, friends, let us start with discussing about a growth company. So what is a growth company? A growth company is a company which is growing rapidly at a pace which is more than the growth rate of the economy or growth rate of the industry. Growth investing as a style is becoming increasingly popular amongst investors as it generates returns faster than deep value investing. Because of the anticipated growth, it attracts many new investors, leading to an increase in the price of the stocks and hence the valuation of the companies. Let us talk about some key characteristics of growth companies. Well, growth companies are usually in the small to mid caps category. They have a large market to grow. They have shown historically a good performance. They have a potential to compound earnings. They have some competitive advantage or moats. Let us now compare growth style of investing with deep value style of investing. Well, in deep value style of investing, an investor tries to invest in companies which are available at discount to their true potential value or the book value. The thesis is that someday market realizes the true potential of the stock valuations and results in handsome profits for the investor. It usually takes 5 to 10 years for a deep value investor to realize the true potential of the stock. For example, we would like to compare HUL and ITC. Well, Hindustan Unilever is called as a growth stock and ITC can be labeled as a value stock. Although both the companies are in the same space, which is FMCG, but HUL is trading at a price to earnings ratio of 73 times, whereas ITC is trading at a price to earnings ratio of 15 times. Now there is an interesting thing. While many experts say that growth stocks cannot be value stocks and vice versa, while we don't agree with it, we can see a lot of growth companies available at very attractive prices. Well, this is because there is a market anomaly. So how about growth stocks coming at cheap valuations? Well, before trying to understand how to pick growth stocks, let us first try to understand how to screen stocks. In screening, you begin with putting forward certain financial parameters which you feel are haves and have-nots while selecting the stocks. And then you try to figure out the stocks that meet the criteria. Now, there are over 5,000 companies listed on stock exchanges. If I want to identify the investable companies, I would try to screen the stocks that out of those 5,000 companies. In our fund, we look at market cap of the company or enterprise value of the company. We usually take a market cap of above 1,000 crore rupees. We also look at price earnings ratio. We believe that the price earnings ratio should be in line with the industry, the company's moats, and the business in which the company is into. We usually take a price earnings ratio of below 20 times. We also look at returns on equity of the company. We feel that the ideal return on equity should be at least 15% when we invest in a stock. We also look at profit CAGR growth rates and sales CAGR growth rates, which should ideally be above 15%. We also look at debt to equity ratio. Now, the company should be easily able to pay its debt from its internal accrual. The ideal debt to equity ratio should be below 1 times. Many a times, debt is needed as a growth capital. That's fine. But the company should be comfortably able to repay its debt from its internal accruals. This is just an indicative list. There could be thousands of more such financial parameters which we could use to screen stocks. Most of the criteria discussed should be seen in light with the industry. These screener filters might also raise red flags for the investors. Say, for example, the price earnings of a stock is 5 times, whereas the industry average price earnings of the similar company in the industry is 20 times. it should raise a question in the mind of investors. The point we want to make here is screening is not a selection of stock, but it is a rejection of stock. The stocks that do not appear investable on screen. For screening stocks, you can use websites like Tickertape, Screener.in, or you can also use paid softwares like Ace Equity, Bloomberg Terminal, etc. In the next lesson, we are going to talk about creating and managing your growth stock portfolios. Thank you.